Have you heard about the recent news regarding LIC and the minimum public shareholding rule? Well, it's quite interesting. So the government has given LIC a one-time exemption to achieve the 25% minimum public shareholding requirement within the next 10 years. Now, what exactly is minimum public shareholding? Now, just to give you a bit of background, all listed businesses in India are obligated to ensure that at least 25% of their equity shares are held by non-promoters or the general public as per the minimum public shareholding rule. Now, this can include individuals or financial institutions as well. Now, the whole idea behind the minimum public shareholding requirement is to enhance transparency in the operations of the listed firms. The minimum public shareholding rule was introduced to address concerns of promoter domination and to ensure that stocks are distributed widely. Now, this in turn brings more liquidity into the markets and contributes to better corporate governance. Now, diving into the specifics, LIC, being the company's largest insurer, got listed in the month of May 2022. Now, during its initial public offering, the government sold over 22.13 crore shares, amounting to a 3.5% stake in LIC. However, the government still holds a substantial 96.5% stake within LIC. Now, this exemption granted to LIC is a notable move, offering them a bit more time to meet the minimum public shareholding requirement, because its earlier deadline to achieve the minimum public shareholding was by May 2027, which would have meant share sales by the government within the next 2 to 3 years. Now, in October 2023, we hit a 21-month high with net foreign direct investment reaching a whopping $5.9 billion. Now, it's pretty impressive, especially when you compare it to the $1.54 billion in the month of September 2023 and $1.16 billion in FDI in October 2022. Now, guess who the major players are? Mauritius, Singapore, Cyprus, and Japan contributed more than 4/5 of the total FDI inflows in the month of October 2023. But here's the kicker. When you zoom out, the overall net FDI from April to October 2023 took a nosedive, dropping by half to $10.43 billion compared to a much heftier $20.76 billion in the same period in the last year of 2022. So why is there a sudden drop, you may ask? Now, you blame it on the global economic slowdown affecting both inbound and outbound direct investment flows. Most outward FDI involves putting money into subsidiaries or stakes in foreign companies, and with fewer opportunities in developed markets due to the economic slump, it's no wonder that we are seeing this decline. But hey, it's not exactly a shocker. This decline in FDI we are seeing here in India is part of the broader global trend marked by uncertainty and the looming possibility of a global recession. The International Monetary Fund, which is the IMF, has been sounding the alarm, reporting a significant drop in global FDI flows. Between 2018 and 2022, these flows have fallen to 1.3% of the global GDP, which is a stark contrast to the highs of 3.3% of the global GDP, which it had seen in the early 2000s. Now, the IMF reports indicate that India's share in global FDI funds has actually risen from 2.1% in 2015 to a notable 3.8% in 2022. Now, for us in India, FDI is a big deal for economic growth. Even though things look a bit challenging now, let's not forget it's just a phase. Once the global economic headwinds calm down, we are expecting a comeback in foreign investment, giving a boost to India's ongoing economic development. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.